9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching the China Show. I'm Yvonne Man with David Ingles.
Good morning. We're counting down to the open of markets in Greater China. Let's get to your top stories today. Oil prices extending gains as the U.S. resumes its blockade of the Strait of Hormuz. President Trump also demanding a 20% toll on ships passing through the waterway.
We're attacking them tonight. We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up discontrolling the whole thing.
The sell-off in tech adding to pressure on risk assets in the region, while bonds drop as traders now add to bets that the Fed will hike rates.
And slowing sales weighs on Shein's valuation. That's ahead of an IPO in Hong Kong that sources say could raise up to $3 billion.
All right, it seems like that war premium is back on in these markets here right now. When you take a look at how we woke up to this morning here with, oil markets spiking some 9-10% when it comes to Brent. And once again, questioning really the state of the Strait of Hormuz, given that now we're talking about potential fees or tolls here. That certainly has really woken up markets here in risk assets today.
Yeah, we're 85 last we checked on Brent prices, and it's now looking like higher prices, whether that's a toll from Iran, or do we call it a tariff from Trump, or a toll from Trump might be a feature.
Or toll's a new tariff.
Toll is a new tariff as far as whatever goes through there is concerned, right? And 30 million, I think, is how it works out to be if a whole tanker is filled with oil is the tariff that we should be considering right now, and as far as that's concerned. So yes, Brent prices are adjusting higher. The dollar is also reflecting the risk appetite or the lack of risk appetite out there. And of course, we have to talk about U.S. inflation and the Fed too. Yeah,
you take a look at how Fed hike expectations have basically shifted in the last 24 hours or so. I think Chris Waller sort of added that sort of discussion as well. July, where I think we're just about 2 weeks away from this Fed meeting, right? And it is increasingly becoming a live one here. When we talk about where the odds are, it's basically now down to a coin toss, whether they do hike or not.
Yeah, it's about 40, just over 40%. And of course, a lot will also depend on what that inflation print later on. And of course, Kevin Warsh also speaks, of course, later this week. So we'll see, of course, how he frames all of these things. And of course, whether or not, in fact, July is in fact live in a couple of, as you can see, about a week and a half from now. On top of all this, but related to this, of course, is we woke up this morning, not just to oil at 80 and now 85. We woke up to a Philly semiconductor index down about 4%. We closed below the 50-day moving average. Yields were melting higher. SK Hynix, of course, the declines in the ADRs overnight. You know what? We opened 5% lower in this one. We're up 4% now. So we'll see what happens when the leverage product traded here in Hong Kong does as things get underway here. And apart from all of this, we'll see how Chinese markets go. We have, of course, Minimax is going to be very much in focus here. We have a lot of policy intentions and measures and plans that have been put in place. We'll get to that later on, but we are called lower across Chinese markets, about 0.3%. And there you go, the adjustment higher in Shanghai crude price. We're up 6% in the early minutes.
Yep, so once again, oil is in the center of investors' minds here and how this relates to bond markets, rates, the dollar, and stock certainly is going to be the key thing. And it brings us back to those, the sentiment that we had in some ways from a few months ago. Earlier today, our Washington and White House correspondent, Jeff Mason, did ask President Trump a pretty interesting exchange here, and really how long he expects the current U.S. offensive to take.
Well, I think it's going very fast. We've demolished their military. We're hitting them very hard. We had a deal yesterday or the day before yesterday was all done, and then they broke up that deal immediately because they found out there was something in the deal they didn't like. And they're wired differently, and we're not going to put up with it.
Pleased to have Jeff Mason now joining us. He was earlier, of course, at that White House in that press briefing. Jeff, just walk us through really what you think the tone was from the president, in that room, and the fact that he's talking about 20% fees in the Strait of Hormuz seems like he's really trying to control the narrative once again. But really, how feasible is that?
Yeah, there's a lot to unpack there. Let's start with the question that I asked him, which was how long does he think that the war is going to last? That's an important question because for a good chunk of the earlier part this year, since he started the war with Israel several months ago, he's been talking about this isn't going to last very long. And he clearly found at one point an off-ramp in the memo of understanding and the ceasefire that has now been thrown out the window. And the president is sort of uncharacteristically also engaging with Congress and saying we are back at war and alerting them to that, which he did not do the first time. So that was the reason or the thinking behind my question today. And his answer was pretty open-ended. And he was pressed on that by another reporter as well. And he said what he has said before when pressed about the length of the war, which is that he doesn't think that this is comparatively very long because other wars were so much longer. And he talked about the Vietnam War today having been so long. So that doesn't give a whole lot of clarity to the markets or anyone else who's paying attention about what his intentions are, other than to say right now it's pretty open-ended. Your second question was about the Strait of Hormuz. That was certainly a big story today, that he's asking for a 20% toll or tariff or tax or rebate, whatever word you want to use. What he did not outline is how that would work and how it jives with international law. Right now, it doesn't look like it would. So that is something that I also think that all of us will be pressing on and asking him about in the coming days.
Jeff, I think about 30 minutes back, there was this pretty important headline that dropped around President Trump and his plans to address the nation. I think it's Thursday your time, Friday morning in the Asia Pacific. What more do we know about that?
Not much. We asked him that. I wasn't the one who did, but somebody else did. And he didn't give a whole lot of detail about the topic of that. He was asked about it in a radio address this afternoon, Washington time as well. And he said, oh, it's just going to be a speech about like a lot of my speeches. So I would wager that there is a reason for this speech, because a primetime address is a big deal for a president in this country. But unfortunately, I don't have a lot of detail to give to you just yet about what that topic will be.
Jeff, nonetheless, fantastic. Thank you so much for the insights and the context there. Jeff Mason, our Washington and White House correspondent. Oil markets are attuned really to the Strait of Hormuz and really how much oil is flowing through there. And it's really how quickly things have really changed since that MOU was signed in mid-June. And as you can see, the flow of oil, this is the moving average, by the way, 70 moving average, according to our Bloomberg economics team that calculated this. We went up to as much as 17 million barrels a day at the peak, and then things cascaded lower, and then Iran started attacking some of the vessels. And then, of course, very, very recently, the U.S. then removed that waiver on Iran. And the headline right now is, for the first time since that MOU was signed, let's call it about a month back, we're now back below 5 million barrels on a 7-day moving average, and as far as the amount of oil and oil products flowing through Yvonne, the Strait of Hormuz. So understandable, of course, when you look at oil market and the reaction there to the upside today.
Yeah, so you're starting to see certainly that things are starting to, I guess, dwindle a bit more as these tensions flare up. I think there's a great story that we're going to hit in the later hours here about maybe potentially the return of Chinese demand, right? Once we start to see there's early signs of some of these oil majors and the like that are really trying to stock up on reserves right now, which really up until now we actually have seen oil imports from China actually fall during this conflict, which has really kind of buffered the oil price up until recently. So certainly that's one thing to watch. Let's bring in Chris Weston now from Melbourne, head of research at Pepperstone Group. Chris, we woke up to the reality of oil back at $85. How should I be looking at this now this morning?
Well, confused, I think, is the issue, because we're trying to understand the probabilities and the assumptions that have been made a week or 2 weeks ago are firmly being challenged. I mean, we're doing assumptions on inflation. Has inflation peaked? That's being challenged. What could it mean for Fed policy? Obviously, that's kind of concern. What does it mean for volatility in broader markets? What does it mean for the dollar? All of the assumptions that we were pricing in and fairly convicted of a week ago are firmly being challenged, and that distribution is widening. Liquidity may be thinning out at the top, but yeah, there's a lot of flow-based effects that are still taking place in the oil market, and that's reverberating around. I mean, there's a lot of legacy shorts are being cut up, and people are flipping now to long positions on CTAs. The options market's coming alive. There's the premium for 1 month calls on WTI and Brent options is blowing up in terms of the implied volatility. It's widening up, and of course, dealers are going to be short in gamma, and then of course in that situation, they're going to be buying the underlying to hedge their deltas back to zero. So, you've got these flow-based effects which still need to work themselves out. But I think at the very issue is this view last week that we had, or that we're going to see this normalisation over time of logistics through the Straits of Hormuz. That was going to lead to a surplus in Q4, a glut in 2027, and that's just now being firmly challenged each day. So there's a lot of, markets are moving around, and that's what we're trying to price that risk and price that certainty, and that's why it's very, very confusing at the moment. We just got to follow price.
Chris, something that's somewhat different this time compared to, let's call it late March, the whole of April, is that when you look at, so AI managed to keep the boat afloat when you look at on an index level, very, very simply. AI started to rotate. We've started to see some wobbles there. Why do you think we are getting that reaction in the equity markets? Or am I just overthinking the connection there?
No, I think you're wise in that assumption. So I think probably what the thing is that when you've got that narrow leadership, that concentration in breadth, we saw the index being fairly well supported because the heavyweights were controlling us. Now what we're seeing obviously is this idea about a broadening of ownership, and people are looking not just within styles and factors but within AI itself. It's like, where do we want to go? Do we want to come out of memory? Do we want to redistribute that into other areas of AI? Do we want to go more into banks, which has been a big trade recently? And I think now people are starting to say, well, look, we want those strong cash flow businesses. We want the low beta businesses at the moment, and go a bit more defensive. So there is a broadening out as we go into earnings season of ownership. And what that means is people have been sort of becoming more market weight in various parts of the AI spectrum, the semis. And therefore, I would say right now, if we were to see WTI crude pushing firmly above 80, if we were to see Brent pushing up into the 90s, and volatility spiking, and then people are really concerned about what's happening in inflation manifesting again, inflation expectations, which collapsed recently, start pushing back up. People start pricing a 60% chance of a July hike, 2.5, 3 hikes by March next year. Then what happens in the equity market is those drawdowns will be more pronounced than what we saw before, because that leadership is being called into question, and those stocks which have supported the index don't carry that weighting. So I think in this dynamic, if the market is challenged, the right tail risks really pick up, then the extent of the drawdowns that we're going to see in the equity at an index level will be more pronounced.
Is there anything in the earnings season coming up? So three major themes are intersecting. You mentioned geopolitics rearing its ugly head again, AI is rotating, broadening out, and you have an earnings story that's coming through. Paint the picture for us these next 4 weeks in the equity markets as we move into the thick of summer too. Fourth element there.
Well, banks as well. I mean, what we're going to see on the net interest income relative to margins, I mean, that's going to be a big one there. And what we're going to see is there going to be any tepid sign of loan growth coming through? But I mean, for me as a trader, it's really about the idea that the average stock in the market is priced for earnings day moves of just over 5%, which is punchy. I think it may actually be underpricing it. The number of companies that we've seen recently that have 10% moves on the day of earnings have been increasing to the highest level for some time. And I think given where the market's all-time highs, just off all-time highs, there is just going to be no tolerance for error. But that said, I think what we're going to be looking at is companies that have rich positioning, that have a really good story that the market still likes, that sells off because the numbers are in line with expectation. They haven't blown the lights out. That sell-off, I think, when you see those sort of conjecture, those sell-offs will be a really good buying opportunity. So they're the sort of businesses that we're looking from a trading perspective. Positioning comes out, still like the story, nothing's really changed, so just met expectations, and I think that's where they're the places you want to be buying the dip. But yeah, from a big level, we're looking at anything around the sort of cyclical story. We're still looking at the idea about hyperscaler demand, the investment in data centers, and whether that continues at the pace which we expect. we see after the earnings season, things like Nvidia gets more of a catalyst, and we start seeing rotation back into the AI story at the expense of some of the low volatility plays. So, there's a lot going on, but certainly, I think my tactic is to buy those businesses that meet expectations but get sold off because positioning's rich, and then we're looking to buy the pullbacks into those businesses.
Okay, let's put some meat on the bone in the next segment with Chris Weston. We use it as a jumping off point. Chris stays with us, head of research at Pepperstone Group. Just very quickly, going into the session today, 15 minutes away from the opening bell, a couple of sectors to watch. Chips, we talked about that. Mining stocks with the pressure and gold, some of the policy pronouncements coming through. In terms of data, June data is coming through, trade data specifically today. We are still in the window for credit numbers. And of course, as we go into the thick of things later on, we also have a CGB sale, so quite a bit of untapped as far as fixed income is concerned. Cutting down to the open of trade in Shanghai, Shenzhen, and here in Hong Kong, futures are lower. The opening bell 15 minutes away. This is the China Show. Okay, welcome back. Futures are now still down, although we're off lows as we go into the opening minutes, early opening minutes, of course. And just very quickly, data, we have the trade numbers coming through today, possibly the credit numbers as well. In terms of some of the bond auctions coming through as well, just keep an eye on that. I think we have new 10-year bonds, plus, of course, somewhere on the long end, also some supply hitting these markets right now. Let's also have a look at where we are as far as policy pronouncements are concerned. We had a couple of things overnight. Can we get that up, please, if we have? So Xinhua reporting some blueprints in as far as consumption is concerned going into 2023. So consumption, we talked about how that is a key priority. More on that. Rehab device industry, 3-year plan. So just really an overhead snapshot, 30,000-foot view on some of the industries and sectors to watch as we go into, of course, these policy national healthcare plan. There we go. Going into the next 5 years.
Yeah, everything from, childcare or the silver economy, so all these things when you look at here in terms of the consumption space this morning. Still with us is Chris Weston, head of research at Pepperstone Group. Chris, it's interesting. We ended the last conversation talking about, the preferred strategy is still to buy on dips here right now. What are you still looking at those pockets of opportunities for you? I mean, I want to talk about chips in particular here. This unwind that we're seeing in Korea and the like, would that still be a buying opportunity for you?
I wouldn't. I'm not. I mean, Korea's a bit too crazy for me at the moment. I mean, I think there's, you still are talking about two stocks in the space, and we've got the sort of the various flow-based effects from the leveraged ETFs on single stocks, which just. So for me, I'd be if I'm wanting to express the view on memory, I'm still going in a micron in that space. I think that's probably where you want to be going. The volatility is still there, which is great for traders intraday and sort of short term, but you're just getting sort of less on the flow based effects on that situation. But I think what we see now is people, the intraday correlations and the realised correlations and implied correlations. Not just in the S&P, they're the 6th percentile of the 5-year range, but also those relationships within chips, within AI more broadly, have come right down. So people are so much more selective than they've really ever been in that space. And people are looking at, it's not just a one-size-fits-all. I think once we get into the meat of earnings season, we're going to know a lot more. I think Nvidia is going to be interesting. The market's searching for a catalyst to really sort of push it back above, nicely, use that $200 as a platform going forward. And there's just so much of the different factors that are working on an idiosyncratic basis, and a lot of positioning has come out. But I think people are starting to look more at the space now about what's happening in China. China putting data centers under the sea. They're doing the open source model. Much of the demand seems to be there. The US are now Trump saying that we want to see more open source models from these spaces. So it's a really difficult one now to come out and just use AI as a one-size-fits-all. People are now looking at the space so much more selectively, and those relationships have really broken down into sector there.
Well, specifically on China, since you talked about that, is there anything specific that's catching your eye?
Yeah, I mean, we don't offer. I don't look too much at the individual stocks. Rather, we're looking at it as more of a competitive play. I mean, it's not just in the internet stocks, but what we're seeing in space exploration as well. I think, the US versus China in all those sort of forms is very much there. But look, I think, global flows need to go somewhere. And I think people are looking at probably the biggest risk, not just to the AI spaces and the chip stocks, but also SpaceX as well. I mean, probably the biggest risk to SpaceX at the moment is what's happening in China's exploration as well. So really, for me, from a risk management perspective, it's about where those flows are going to go, and are people seeing a relative attractiveness in China, especially when you've got the authorities there probably backing a lot of the movement that's taking place, and those chips are very cheap in China on a relative basis as well, and very effective. So I think, I won't talk about individual names as such, but we are seeing the idea that one of the biggest risks to SpaceX and also, obviously chips in the US is what's happening in China and where those flows are going to be going.
I think we covered oil, we covered equity markets quite extensively. What in terms of risk assets and other asset classes that you're looking at? I mean, obviously the dollar and the rates markets are moving. What are you looking out for there in terms of what could lead to more of a sustained sort of breakout of the dollar now, Chris?
Well, I think one of the things we're looking at now is really what's happening in the real rate space. I mean, it's driving nominals. We're seeing a breakout in twos to new cycle highs. So, we've seen that movement up in the 2-year real rate, as I say, to new highs. That's taking gold down as well. But, the moves we're seeing in the dollar are glacial on a relative basis. We're obviously seeing very high volatility re-emerging in the crude markets. We're seeing some buying of skew in equities as people look to hedge out some of that risk around single stocks and an index level as we go into earnings season. And as I say, the earnings one-day average move is expected to be up or down a sort of 5.1%. But, I think the dollar moves, really, I think we're going to need to see continued move up in real rates, not just in twos, but across the back end of the curve as well. And I am a bit sceptical about what's happening in the Fed rates pricing. As you say, the US dollar IS is now implying a 44% probability that they hike in July. I don't see it happening. I think the Fed are obviously institutionally dovish. I know that we've been hearing positive or hawkish rhetoric of late, but I think when we can look at this CPI number in the session ahead, is it stale now? I mean, the idea that the inflation has peaked, a lot of people have been saying CPI and PCE have peaked and will dissipate. Is this now a thing where, if we're going to see this, oil back above $90, and if we're seeing WTI back up, firmly above, firmly higher, then, and we're seeing agricultural prices higher, is this going to lead to a rethink of that situation? Can the Fed raise rates in a situation where that situation is moving around so violently? It's just a very difficult one to do. So I think we need to see that interest rate pricing continue to build, and the real rate story to continue to push higher. And I think, the dollar continues to kick there.
Chris, thank you so much, sir. Chris Weston, head of research at Pepperstone Group. We were just talking about oil. We'll leave you to look at some of the big oil players in China to the upside. More ahead. This is The China Show. Right, direction of travel going into the opening bell today is lower. That's what happens when you have a resurgence in oil prices. In case you missed that, we're back at $84, $85 a barrel in Brent. The opening bell coming up next. This is Bloomberg. Welcome back. You're watching The China Show. I will juxtapose these two things. It's hard to imagine these two cities are just 2 hours apart. It's blue skies, clear, and everything else in Shanghai. It's the clouds of Mordor have gathered over Hong Kong, and what a change it's been in the weather here.
It is just night and day, it seems like, here. When you talk
someone
about...
needs to clean the camera.
No, I think it's just the clouds that are just really coming over here in the city. But certainly does seem a bit ominous when we take a look at how risk assets are doing here. We woke up to Brent back to around $85 here this morning here on the back. Of course, these flare-ups between the U.S. and Iran. The U.S. there once again reimposing that blockade in the Strait of Hormuz. And now they're talking about 20% fees or tariffs or tolls or whatever you want to call it here. So as the market tries to decipher just how legal that is, the legality of this, how is this going to work market practice, but it seems like the markets are still now going with it and actually taking some of these words from President Trump pretty seriously here this morning. So that's why you are seeing Shanghai crude, there you go, reflecting that. We're up close to 9% when it comes to futures there in Shanghai this morning. And that's why you have seen the likes of equity markets starting to see that downfall here across the region. But we are flat when it comes to, of course, Shanghai Composite here today. CSI 300 seeing just moderate upside, but Shenzhen still seems to be doing okay. Capricorn Tech could be one reason, right? Look at that. We're still seeing these domestic chip stocks doing okay, despite the fact that the SOX index fell some 5%. You had some of these big sort of, SK Hynix in the U.S., the second day of trading, also fell quite a bit here. So certainly a lot of questions around this unwinding of this whole Korea trade. What does that mean for the likes of the overall semiconductor space here this morning? So there you go. That's what's going on. We're watching very closely the consumption space here. There was some policy moves here about some sort of consumption plan here. So we're watching everything from liquor makers to Midea Group to even like childbirth or child care stocks, silver economy, all those things, right? So certainly that's one thing that maybe could move markets here today. Let's look at Hong Kong in particular as well. We did see a bit of pressure. There you go. It seems like, once again, HS Tech is falling. We're down about 0.75%. Now that we're starting to see some investors ease back into this space, today is not one of them. When you see Alibaba, Tencent, Meituan, Baidu's down close to 5% there. Xiaomi might be the exception here this morning. It's been a pretty solid dollar-China trade, though, despite the dollar moves that we've seen. It's 678 levels here right now. But yes, quite a bit of risk aversion here when it comes to the property space here this morning as well. Maybe the rate story certainly could be one thing that's rolling that here today. Oil stocks are doing this. Upside continuing here when it comes to some of the China majors here this morning. PetroChina is up and really leading the charge here right now. A lot of questions about what that import number is going to look like when it comes to China, when it comes to oil. There has been some indications that they are looking to stockpile once again. That might once again lead to some more upside when it comes to oil prices there, and maybe potential too. We'll talk a little bit more of that coming up. Of course, on the flip side, you got the airline sort of thing, with oil prices now back to around 84, 85. We saw jet fuel prices have surged as well in the last 24 hours or so. So there you go. You are seeing some of these airlines falling because of that. China Eastern seems to be lower by 3% and leading the charge lower. And then we're watching SK Hynix, right? So it's interesting what's going on in the leverage ETF space because it's still doing okay. There you go. 6% pop there.
I mean, we asked this question to Chris Weston, who is a trader through and through, and he thinks this is too crazy for him. Just think about that, right? It's too crazy for someone like Chris, but it's not too crazy for someone who is retired and has their entire life savings into a leveraged product, such as the world we live in. CSI 300 very quickly. So we touched on this earlier on. We're actually back to the 200 moving average for the very first time in a couple of months. And in fact, if we break below this, we haven't meaningfully traded below this for about almost 2 years now. So just watch this line very closely as we go into the thick of things, to the downside. We are testing that level as we speak. Okay, let's flip the page, have a look at where we are on TSMC. After the bell yesterday, out with some sales, we are down about 0.8%. The big number, I'll round it up, 40 billion is the calculation coming through. The percentage change is about 36%. So still, I guess this is a company that's still managing to grow. For more on this, Stephen Cheng, our Bloomberg Intelligence Senior Industry Analyst, is here with us to talk us through your reaction to the numbers and what is driving the strength there in the revenues.
Okay, the number obviously coming in line with market expectation, which explains why the market was basically flat today. But the number itself, it grows like 36%. The company's guidance is about 30 for the full year. So I think obviously you can say it's better than the company's management guided. But having said that, the company has been managing their market expectation pretty tightly based on what they did historically. So I think the obviously investor might expect them to maybe do some adjustment on their guidance in the coming earnings call. But for the growth driver, clearly AI is a driver, and more specifically, a lot of AI chips are based on their 3 and 5 nanometer nodes. Those are actually highly efficient nodes, meaning that they generate very good margin for the company. So the growth there, not just supporting the revenue, but also supporting the earning. So all things are actually pretty positive.
Yeah, I mean, it seemed like it was a pretty, in terms of monthly revenue, I think it was a record that they've reported. Yeah.
Yes.
What does this mean? I mean, the next test is going to be the earnings on Thursday. What should we be looking out for the second quarter?
Yeah, I think the margin should be pretty good, given the sales mix is actually supported by, as I mentioned, very efficient NOS. And then going forward, aside from AI, we'll see some seasonal driver, some of the smartphone chip, particularly from Apple. Those will be, even though it won't be as strong as AI, but still is an incremental contributor. But the sales mix-wise, because those chips are made in 2 nanometers, which are advanced, good pricing, but may not be as good in terms of the gross margin. So those are a little bit mixed factor there for the second half margin outlook. But I'm not saying that you should start to turn cautious. It's more like things are becoming slightly more complicated, and we're obviously looking forward to more color provided by management.
All right, Stephen, thank you. Stephen Zhang there. I'm sure we'll have you on Thursday or Friday when those results come through here. Our Bloomberg Intelligence senior industry analyst. I think it's part of his job, yeah. All right, let's talk a bit more about Shein here. Bloomberg has learned that the Chinese fast fashion retailer is seeking to list in Hong Kong as soon as August after securing approval from China's securities regulator. And the firm is seeking to raise about $2 to $3 billion in this IPO.
Yep, Min Lo, our China correspondent, is here with us to talk us through this long journey to finally list in Hong Kong. And what more do we know about this $3 billion figure?
Yeah, it's been a multi-year journey, right? Because the company had wanted to list in New York and London. Both times they were thwarted in their attempt. There has been so much scrutiny over this company because of, allegedly that it was sourcing cotton from Xinjiang, some of the working conditions of the factory workers. There were concerns around the environmental impact of fast fashion as well. So there had been a lot of political pushback back when it was trying to list in New York. And then the same thing happened in the UK when it faced a legal pushback from an NGO that was fighting on behalf of the Uyghurs in Xinjiang. So now, a year after it applied to list with the Hong Kong Stock Exchange, it finally has the green light, aiming to list in August of this year. But yes, as you can see on the chart there has been a lot of pressure on its valuation. It's now, according to sources, valued at about $30 billion or so, which is about a third of what it was at its peak.
And what it was back then this company is very different now. I mean, tell us a bit more about, they've been trimming at this valuation quite a bit. What does the earnings picture tell you now?
Yeah, so they were doing really well, especially during the pandemic. But then if you look at some of the statistics we have been able to get so far, you look at the app downloads, for example, it's been pretty flat over the past year. You look at the global web traffic, it's seeing double-digit declines as well. But this is partly because of the macro picture, right? You have inflation, you have fuel prices going up that pushed up retail prices. It has put a dampener on retail appetite. So here you can see there's a chart showing the web traffic growth. The orange line is Shein's. It's seeing a downtrend there, but PDD is doing worse there. But you look at the U.S. sales as well, it's also seeing double-digit decline, and it's faring worse than PDD and Amazon as well. So pretty challenged outlook. And you add to that, there is the regulatory challenges as well, because it's been going through all that, the closure of the de minimis loophole, which really forced it to have to change its business model, right? It can no longer rely on the high-frequency, small parcels, direct-to-consumer model. It had to invest in warehouses, increase the consignment values, all of that pushed up business costs. So yes, the margins are compressed, but it's reportedly still a profitable company, and it has evolved over the years to expand beyond just fast fashion. It's now, a more well-rounded e-commerce company selling everything from toys to household products. So still some potential for this company. We'll have to see how it fares amid all that regulatory battles.
Yeah. We'll continue to watch that one there. China correspondent Min Lo on the latest when it comes to this Shein IPO. We are actually getting a bit more lines here when it comes to where we are in this whole AI discussion, right? This is SoftBank CEO Masayoshi Son is speaking here at the company event. And he basically says, asking if AI is a bubble is, quote, incredibly foolish. And he says to seize the fusion fueling data centers post natural gas. I'm trying to figure out what that means. But yes, he seems to be, pouring some cold water on those that are doubting that this bubble has popped.
Don't ask. Right? Okay, we won't. In case you're curious where oil is, though, in case you're asking, 84, 85 on Brent. Shanghai crude's adjusting to the upside. We're up 8% now. Yes, so this is the market story today. And that gas futures in The European contract is up. I think we're at 3-month highs there on the back of everything else that's taking place in the Middle East. In fact, just on this note, right, coming up, we'll talk about how this bleeds into the U.S. inflation story. We get an update later today. Adam Posen joins us in a couple of minutes to take us through his take on the macro. Lots more ahead. This is Bloomberg. Okay, the bond story is, I mean, somewhat misleading when you look at it from a snapshot perspective. But that's just to say from 24 hours ago, yields are much higher currently than they were this time yesterday. We are getting, obviously, a pullback in yields in the U.S., but it was quite a sizable move going into this morning. It's just reflecting that catch-up move. And, of course, we'll see what happens with the inflation print that comes out later today. Out of the U.S., and of course, Kevin Warsh also speaks this week, so we'll see what he makes of all of this.
Yeah, we're set to get that inflation report out right later on, and our next guest warned as early as February that inflation could actually reach 4% this year. Interesting, we have him here in the region as well. Joining us now from the Bank of Singapore CIO Summit in Hong Kong is Adam Posen, president at the Peterson Institute for International Economics. Adam, it's always great to have you here, especially when you're in Hong Kong. That 4% print, I mean, back a few months ago, seemed a bit, out of, most people probably were scratching their heads thinking what could possibly happen. Do you still feel that way now, given just how quickly inflation expectations and oil markets have moved the last couple of days or so?
Yeah, thank you, Yvonne, for having me back in Hong Kong. And I definitely stand by the call because what I argued, and then jointly with Peter Orszag of Lazard, we argued was essentially everything was primed for inflation in the U.S. You had a tight labor market. You had actually pretty loose monetary policy. You had drifting inflation expectations. And so whatever shock was going to come, we thought, and I would argue likely was going to accelerate and go up. I obviously didn't foresee the Iran war mistake, but I did foresee that something was going to happen. I also thought, and the New York Fed's latest data shows this, that there's still more to come from the tariffs and anti-migration policies in the U.S., still kind of pass through to consumers and end users. So, yeah, I think inflation and therefore interest rates are going to keep surprising to the upside through this year.
So Adam, David here, if 4% was your projection before the war started, before this pass-through of tariff inflation you alluded to just now, what's the forecast now? Is 4% the low end or even the floor in your thinking now currently?
It's a fair question, David. I initially, last fall, was suggesting 4.5%, and then when President Trump didn't do any extra tax cuts in the State of the Union, I cut it back to 4. I think now we're at 4.5 to 4.75. It's still a matter, as some of the Fed officials have been saying, about the second round effects. I mean, but I think when you see people recognize that the Straits of Hormuz are not going to be solved, that the energy price changes are not going to go away, and therefore they start to learn, as I've argued elsewhere in writing, that we're in a new economic geography where you constantly have geopolitical shocks you have to price in. I think that also feeds the inflation expectations. So 4 is not a floor if the Fed was to suddenly put on the brakes or somehow the U.S. was to suddenly get capitulation from the Iran Revolutionary Guard Corps. But ruling those out, I think you're looking at 4.5 to 4.75 by year end in U.S. CPI.
What does the Fed do in that context then, right? Given the fact that geopolitically things are evolving and moving very very quickly here, what the reaction function of central banks certainly is in question. Can the Fed bring inflation back to 2% without raising rates, you think, Adam?
I doubt it. I doubt it, Yvonne. I think, and I've been saying again for a while, I think the Fed's going to be raising 25 bips each in the December and the January meetings. I don't think that's changed much. I put a tiny bit of weight call it 20% or less, that they raise in September or October. But I think that would mean raising very close to the U.S. midterm elections, which the Fed traditionally doesn't like to do. You would need something showing up in inflation that wasn't just energy prices or direct interference from the war. But I think by the time we get through the November elections in the U.S., the first meeting after that, they will be hiking. And I'm hopeful they'll announce a tightening bias after Jackson Hole.
So, Adam, investors are trying to figure out now how the U.S. economy will look relative to other economies out there, simply in terms of the paradigm of asset allocation. The economy held up well in the previous hiking cycle. How does the economy look 12 months down the road, in your view?
In my view, and we're talking about asset allocation short and long term here at the Bank of Singapore CIO Summit today, in my view, the economy in the U.S. looks a little weaker, a little slower growth, meaningfully higher inflation, higher rates, but nothing disastrous. I think not only does AI keep going, but of course it's going now being financed externally, as opposed to until about 6 months ago, all the big hyperscalers, all the big supply chain to the AI were all mostly financing through own retained funds or stock prices, but now they're actually borrowing. So that also puts some slowdown on the rate of growth in the U.S. But as I've been arguing, as my colleague at Peterson, Karen Dinan, has pointed out for a while now as well, the household balance sheets, the non-corporate financial balance sheets in the U.S., the non-financial corporate balance sheets in the U.S., both are very strong. They're not quite as strong as when we first came out of COVID, but there's very little weakness there. So we're effectively only at the start of a tightening cycle if the Fed were to tighten. So we got a ways to run yet, I think.
How are you assessing the health of the U.S. consumer now, too, Adam? If we talk about Apple raising prices because of all the bottlenecks that they're seeing within memory, that the consumer is going to have to take a bite out of this, given what we've been seeing with this whole AI boom. How would you assess really the U.S. consumer moving forward?
I think the K-shaped narrative, the idea that the consumption's being driven primarily by a small segment of rich consumers or high-income consumers, was always vastly exaggerated. If you go back, I published something in Bloomberg Business Week, actually, in January, forecasting that explaining that it takes time for businesses to make up their minds about when and how to pass through to consumers, when and how to get alternative sourcing from China or Mexico or bring production home. And so a lot of that pricing is coming through now. It's still to come. You gave the example of Apple. New York Fed released their survey of businesses a week or two ago, which said that very explicitly. And similarly, I think, unfortunately, we're going to still see more outflow of migrant workers from the U.S. We've pretty much zeroed the inflow, but I think the outflow is yet to come. So, again, it's a very mixed picture. The inflation creep is happening, but the balance sheets and the job prospects of most Americans remain very solid. So it's safe to say that consumption isn't going to collapse anytime soon.
Adam, just to get your final thought on mainland China and the economy there, how has that story permeated to you in the U.S., for example? How are you looking at this economy right now?
Well, I and my colleagues at Peterson, like Tianli Huang or Martin Scherzempa or Mary Lovely, are looking at it very differently than the average Washingtonian, let alone the average American. I think the average Washingtonian is looking at it as just in terms of security threat, competitive threat, the subsidies, and not fully realizing that, again, China, like the U.S., is enormous and is a very mixed picture with huge technological progress, but also huge youth unemployment and a very flat small business sector. That's the sort of more nuanced view that the rest of us would have. And I think China is going to be a flashpoint with Europe and U.S. going forward, unfortunately, but that drama can wait until after the midterm elections, probably.
Okay, a drama to look forward to. Adam, thank you so much. Adam Posen, president at the Peterson Institute for International Economics. Thank you so much, and very nice to see you in the region, sir. More ahead here, coming through out of the Bank of Singapore CIO Summit taking place here in the city. M&G Investments CIO Fabiana Fedeli will be joining us later on the show at those times to really basically tell us where they're investing and what they're avoiding currently. Lots more ahead. This is Bloomberg. Right, welcome back. Baidu to our right, on the wrong side of the winner-losers column today, the biggest decliner across the benchmark today, 7.5% to the downside. We're putting this down to, well, there's a trimming of a price target. Still a buy, though, from UBS, but slightly lower here, coming through from the bank here on Baidu.
Yep, so that's certainly one that is really dragging down Aegis Tech here this morning, and we're checking when it comes to oil as well, because obviously when it comes to oil markets, we're back above that $80 handle here, $84 for Brent. WTI is just getting closer back to $80 as well. Natural gas also, we continue to watch futures there, are up slightly as well. So certainly that is where the barometer of risk is really back to oil markets after what we heard from President Trump, talking about potential fees or 20% fees or reimbursements here for vessels that go through the Strait of Hormuz. And there you go. It is really leading to tech to fall out of bed here this morning. Aegis Tech is lower. Taipei, they're a bit of a catch down story, but that TSMC, even though they had record revenue there for the month, wasn't enough to really satisfy the market. And of course, we are counting out those earnings coming through on Thursday from the company as well. Kospi is now flat as well.
Okay, Chinese benchmarks about 25 minutes into the cash market session. We've talked about Hong Kong. CSI 300 on your screen, seeing a bit of a bounce right now. Lots more ahead in the second hour of the China Show.
Welcome back to the China Show. A look at the HSI half hour into the session. Yeah, the weather is not looking too good here right now. It is pretty cloudy. It's been raining, and certainly you kind of feel that across risk sentiment here this morning. Now that we woke up to the reality of oil back to around $85 for Brent, and certainly the flare-ups that we've been seeing between the U.S. and Iran. This blockade from the U.S. is back on the Strait of Hormuz, and the threat of 20% tolls at the Strait of Hormuz certainly is waking up this market to look at things a little bit differently now, that maybe we are looking at maybe a Fed meeting that could be live in just a few weeks too, Dave.
43% probability based on, I think, Fed Fund futures going into the end of July meeting out of the Fed, probability that they will hike interest rates. Let's call it coin toss odds, right, as Yvonne was pointing out earlier on. So that's really weighing on risk sentiment, risk appetite, rather, and we're looking at 1% declines here on the Hang Seng Index. A look at some of the big movers on the index to the downside. We talked about Baidu and the price target cuts. They're coming through out of UBS. Still a buy, though, coming through out of the company, Tencent and Xiaomi. Nikkei, Topics, Kospi, and Taiwan, which is, keep in mind, of course, we were shut on Friday, so this is somewhat operating on a one-day lag. So catch up yesterday, catch down to the sell-off across chips yesterday. Into overnight, we were down 4% on the SOX index, so we are down on Taiwan, down about 2%. That's despite, of course, some very good numbers coming through out of TSMC. The Kospi index is, okay, it's now down 1%. Okay, we need to keep doing this almost on a minute-by-minute basis. The pain point today, as Yvonne is pointing out, is oil and energy prices to the upside.
Right, because we're back to that discussion, right? Whatever the oil price does, it affects the equity market, it affects rates, it affects dollar. And so really, when we thought that inflation, the worst of it was behind us, we're now waking up to the reality that maybe inflation is really something that we need to worry about again ahead of that U.S. CPI print. We're expecting actually a softer headline number, but we'll see if that changes, right? And is that data really kind of stale at this point, just given how quickly everything is moving and the geopolitical sort of headlines are evolving day to day here. So certainly one thing to really deal with here as we count down to Kevin Warsh's testimony this week as well. You have Chris Waller also making a bit of a more hawkish pivot overnight as well. There you go. Oil markets are doing this here right now. Shanghai crude certainly is feeling it, and it's the upside here after we did see Brent and WTI spike about 9% when we were sleeping. So certainly we're extending that upside and that extent here, ascent, I should say, of oil prices. And that really is leading to the likes of PetroChina, CNOOC are 2% higher here. Shipping stocks, certainly this leads to a lot of questions of what rates are going to look like here, the uncertainty around tolls and the like. Maybe that could be beneficial, I guess, to the shipping industry, but certainly a lot of volatility there too today. Yes, very, very much so. In fact, just to reiterate, Costco Shipping Energy, so not this specific ticker, 1138 HK, we're down about 4.5% on that one. So it's really on the transport sector, although you are going to get, of course, some winners on the other side of this trade. Okay, let's talk about the oil story. Joining us now is Nicholas Lua out of Singapore, our oil reporter. Just to help us understand, we went at 70, we were flirting in the mid-70s yesterday. Here we are in the mid-80s. Nicholas, what are people telling you? How far can this one go with this new information we have today?
I think crisis mode fears are back on, David. It's very clear that the war isn't going anywhere. Trump has already said that he will strike Iran today and tomorrow. So that's at least 2 more days of strikes. And I think this is the 3rd day already, right? So whereas the last time we were in this sort of like game of brinksmanship, like Trump was very quick before the Monday open to pull this back, to say, okay, you know, we're kind of done, we're de-escalating. Now we're seeing the complete opposite. Like this is just holding true that the rhetoric about the ceasefire no longer being around, that's clearly come to pass, right? It looks like things are escalating. We've seen shipping attacks in and around Hormuz. We've seen the threats of that 20% that Trump is saying that he's going to levy on ships passing through the strait. That's way more than anything Iran has charged.
Yes, I mean, 20% toll potentially, right, is what President Trump is proposing. How would that work in terms of the enforcement of this? What would that look like in practice, you think?
I think in practice, Yvonne, there's a lot that's really not clear right now. What we heard from the president was a sort of like throwaway bit that he was posting in a tweet, right? So in a way, this isn't like clear foreign policy. This isn't a document that we've seen come out of OFAC. This isn't like a tariff-ish thing that ship owners have all received. So I think there's a lot of uncertainty right now as to how seriously we'll take this, how much of this is part of the rhetorical game that he's trying to play with Iran. Although, again, I'm not exactly sure how trying to charge a higher toll than the sort of like fees Iran has been charging is supposed to somehow balance the market. So there's a fair bit of chaos here.
Oh, well, yeah, I mean, just to underscore, I guess, that point, the stockpiling story that, and fantastic reporting, by the way, from the energy team today. Take us through the China context and the China angle here, and how perhaps they're looking to restock some of the reserves that they, of course, used to cushion the blow of the spike in oil prices in March and April.
Yeah, the 2 things to think about when it comes to China aren't entirely too shocking. 1, it's about policy, and 2, it's about economics. We'll start with economics, right, basically. When you want to refill a strategic stockpile, it always comes down to price. As you said yesterday, maybe ending the week last week, we were much closer to the 70s, right? And so that's the kind of level where should things fall even further, should the crisis look like it's abating, should flows, physical flows through the Middle East actually be coming and getting the crude barrels that stockpiles like in China would want to buy, then of course people will look at restocking and filling up those strategic stockpiles. China's sort of been a bit of a strategic solver this crisis. They haven't been buying and they've actually been drawing on the strategic stockpiles. So now's a good time to renew, right? And again, like last year when prices were low, to look at historical precedent, China bought into this SPR and they stocked up. The other thing to think about, of course, when it comes to China is that no decision is entirely driven by economics, and it's also partly policy driven, right? So I'll point at how our reporting is showing that July exports, which are much higher, July fuel exports, so things like diesel, gasoline, the stuff that the world is so short of right now, they were saying that those supplies will continue to come, right? And so what that means is that if they're going to be exporting more and they're going to be running their refineries higher, that's going to require crude. And that crude's partly going to come from the strategic stockpiles already there. But now that there's a replenishing flows are also going to come from there as well. So I think that's the kind of like new equilibrium we're shifting towards when it comes to China. But in a situation like right now, when again prices are back in the mid to high 80s, like if I were the Chinese, I might think twice about again coming back into the market right now.
Nicholas, thank you so much. Nicholas Lua there, our oil reporter in Singapore for us. How much oil is flowing through the Strait of Hormuz? It's the key question really a lot of people are asking. On my right is a graphic from Bloomberg Economics here, the data that's been crunched. 7-day average, millions of barrels per day. They managed to come up with these estimates. Fantastic set of numbers, of course. June 17, that's when the MOU was struck. So call it about a month back. We went up to 17 million barrels a day in terms of the moving average. And that's when, of course, the U.S. removed some of the oil sanctions waived some of the oil sanctions on Iran. We went to about 11 million, and that's when the skirmishes and some of the strikes then resumed. And then the headline here is for the first time since the MOU about a month back was signed, we're back below the 5 million barrels per day average flowing through the Strait of Hormuz. So that's oil, Yvonne, oil and everything in between, including, of course, oil products there.
Yeah, I mean, for all these tankers and all these shipping companies, there's a lot to really decide on here, right? First of all, not just the safety and the like, but really, what is it going to cost to really get through to this natural waterway right now with the threat of now tolls and the like. Lots of questions really for the shipping markets here this morning. Joining us now from Sydney, we're going to bring in Mukesh Sahdev, founder, CEO, and chief oil analyst at XAnalysts. Mukesh, it's always great to have you back on the program. Let's talk about the possibility of tolls right now. Do you think this is actually going to, legally speaking, can this actually happen?
To be on the show, I think is a tough question from a legal point of view. But if you look at the history of how the U.S. Has done a few things, yes, U.S. Has shown that they can do much higher than what others can think about. So I think this, to me, is another way to negotiate and drive an outcome. This is also telling me that this time around, U.S. wants the oil to continue flowing rather than it stops completely and just it as at a higher price, higher cost. So I guess that this is more symbolic threat, again, as a negotiating leverage. It might likely put pressure on all the Gulf states to put pressure back on Iran or other mechanisms. So to me, I think technically very difficult. But yes, we have also seen in the past that some of these big numbers, when U.S. puts tariffs in 150%, it does execute. But the question is the sustainability and how long. Maybe one day they can charge, but certainly not for long.
Mukesh, for neutral external players who are simply buying the oil and energy that comes through the strait, it's almost a moot point who you're paying to, whether that's Iran or the U.S. And my question is, structurally, is the world faced with just structurally higher energy prices, regardless of whose pocket it goes into?
Well, you're absolutely right, whose pocket it goes into, and we never know whether Iran charges first and then U.S. charges the second toll. So we don't know those things, right? What I would actually say is that this second round of Hormuz crisis is going to be a very big double whammy for Asia. And my reasoning is like that when the Hormuz crisis happened in January, we were pumping about 525 million barrels from the top Middle East 8 countries. That number dropped down to very low levels in June, and in the first 10, 12 days of July, we were almost pumping back what we pumped back in June. So we use the alternate mechanisms of pipelines, the Bab-el-Mandeb Strait and other means, and the world somehow worked. And the Asia buys crude in advance. So now the challenge is that Asia might not buy the crude in advance from the non-Gulf states, and the Gulf crude doesn't arrive, and the demand is going to go up from July to December in this Asian market from 4 to 5 million barrels per day, and the stocks are low. Stocks low, demand going up. We don't get the Gulf crudes, and we missed the window to order the barrels from the long haul from the Atlantic basin. That's the kind of a scenario I think energy buyers and crude buyers need to worry about.
Okay. Certainly that's one thing that we've been talking as well. I want to flash these lines that are crossing here from Iran state media or press TV. Is they're saying that the RGC has struck the comm center and U.S. staff housing at the base. This is the Jafar base in Bahrain. And they struck some weapons depots there. So certainly you are still seeing some flare-ups that are happening between the two sides here this morning, Mukesh. A lot of people are trying to assess, this recent flare-up of tensions. It seems like there's a pattern. They're going to, do a few strikes. It's relatively contained, and then they call an end to it. Do you think this is sort of the pattern that will continue, Mukesh, or do you think that there is a chance or still a risk here that we go back to sort of what we saw maybe early, March and April, where energy infrastructure was targeted, and we see more flare-ups in that sort of extent?
Well, I think as the negotiations do not result into some outcomes, the war goes on and the chances of miscalculations increase, in my view, number one. Hormuz is not a highway. Hormuz is a lane drive. And which lane you want to cross, Omani lane, Irani lane, and might be the U.S. lane. So things can go wrong terribly as well when people are rushing out at very high speed. So I think that to me is more worrisome rather than the military part of the equation. The military part, again, we might hear the same pattern that let's get back to the talks. That's the whole purpose of bringing Iran and other countries back to the talk to use this strike. So I think that's what I'm more worried about. As I mentioned, that the another big worry is the Russia, right? Russia is using the Bab al-Mandeb along with Saudi Arabia at the max sort of levels. And with what's going on in Russia, with crisis and hitting on the refineries in Russia and the sanctions bill that might be coming up, I think we are, in my view, entering into a much difficult phase for the Asian markets compared to the first round of the Hormuz.
So Mukesh, put that to us in the terms of an oil price range, because some of the forecasts out there on the range are frankly useless from a practical perspective. I'm looking at some people have put out ranges of 75 to 105. My boss might as well tell me he's going to raise my pay 50% or fire me the next day. What is a more practical price range that people should assume on the oil price?
Excellent question, and I think really like the question. That if you look at the movement in the oil curve since 1st of January this year, there are three clear price regimes we have seen. There is a lot of crowding of oil price between below 70, and there is a lot of crowding of oil price above 90. Typically, the oil prices do not like to stay in the 70 to 90 volatile range. They gravitate towards either lower than 70s or higher than 90s. So at this point of time, when OPEC also is in a bit of a disarray, which was a big stabilizing force in the market going forward, its absence. So I believe that this 70 to 90, if you want to really narrow the range, it could be 75 to 85. That's where the oil prices will keep on oscillating till we find a situation. Why the oil prices will not go very high? Certainly because demand correction, I think Asia has lived through that phase, and that might come back up again, while the oil prices might not go too high as well, because that also hurts now U.S. economy, because U.S. crude stocks are down to lowest levels. U.S. gasoline stocks are down to lowest levels. U.S. diesel stocks are down to lowest levels. So U.S. might give some, again, waivers to Russia and other places to keep the oil prices sort of lower. So my view is that if you want a very narrow range, 75 to 85, if you want a little bit of a broader range, 70 to 90, but definitely not below 90 at this point, definitely not below, sort of the below 70 or above 90. The only situation where things can really go wrong is when Russia, as an oil system, which is about 7 to 8 million barrels of crude and products exporter, really goes into a tailspin and we lose the Russian oil system. Then probably we might go into the 90s or the 100s.
How does the China factor in for you too, Mukesh, here? There's signs that they may be looking to replenish some of their stockpiles once again, the return of the Chinese buying oil. How do you think that's going to change the calculus and basically where the oil price goes from here?
Good question. And sometimes I believe that China doesn't care about the oil price. China plays a very strategic, very opportunistic equation. Let me give an example. Of course, stockpiling, China is biggest strength, and China has more than 1 billion barrels of oil. You were showing the chart earlier, and they have drawn some stock. So China will continue to buy. And during this period, when there was this break in the crisis, they purchased quite a lot. Till last week of June, the imports arrivals in China was falling into a weekly low of 4 million barrels per day. This week, the numbers had jumped back to 7.87 million barrels per day. So China will buy. But I think what is most important to understand is, will China use this crude, which it purchases, to run refineries hard and give products back to Asian economies? My answer is no. What China has actually done is use the crude to make more petrochemicals. Naphtha, LPG, petrochemical products coming out of the Hormuz, to me, is a bigger story, and rest of Asia was not getting any chemical feedstocks. So China actually took advantage and exported huge amount of petrochemicals actually to the world rather than the fuel. So my view is China will continue to buy crude oil, stock up the crude oil, run crude in refineries very smartly, not produce too much gasoline, diesel, or jet, but maybe produce more petrochemicals, and then capitalize on the delta, which is maybe 3 times between naphtha versus a propylene, polypropylene kind of prices. That's where the real margin is. So crude to chemicals is what, in my view, China has done. Until Hormuz remains constrained, that's what, in my view, China will likely do.
Mukesh, thank you, sir. Mukesh Sahdev, their founder, CEO, chief oil analyst at XAnalysts. Thank you so much, sir, for the insights. In fact, just on that very note, right, we will get more details on exactly, at least in the month, that is being reported currently by the Customs Bureau, exactly how much China actually imported as far as fuel is concerned. Until we get that breakdown, what we have so far coming through here is a year-to-date figure. January to June, so first half exports in renminbi terms were up, let's call it 13.5%, just to round up there. Imports, also in local currency terms, are up 22%. In terms of context, China is still facing some challenges as we look into the second half, given, of course, trade barriers rising. And still, so far, not a lot of context still. But yes, just to mark that this is ongoing, and we are still waiting for the breakdown of the numbers, both in local and also dollar terms.
Yeah, I mean, Bloomberg Economics believes that export growth likely could have picked up for a third straight month here in the month of June. So really, it's been propelled by the strong global demand for for AI hardware as well. So we'll see if that plays out here. We'll have plenty more coming up. This is Bloomberg. All right, Kospi is back down here right now. We take a look at when it comes to what's going on. SK Hynix shares are lower by 3.5%. In relation to that, of course, is the leveraged ETF that tracks the stock here. We're down some 8% in Hong Kong here. So extending this route that we've seen after that record 15% drop yesterday in the South Korean shares. Let's bring in our Asia equities reporter, Sang-Mi Cha, who joins us now. We saw a little bit of that fallout really spill into the U.S. session as well. Sang-Mi, just walk us through what you and your team are talking about here today regarding, of course, this whole chip trade.
Yeah, Yvonne, yesterday was the so-called Black Monday. Here on the ground, people were actually in fear. Everybody was talking online that their leveraged ETF positions have been wiped out, and everybody didn't look that happy like on the streets either. But now we're seeing the SK Hynix stock fluctuating. We have seen as much as 5% up and then as low as 5% today. And it's become very, very common in Korea for SK Hynix to move above and beyond 5% every day. I think there were 50 sessions or more this year alone where we have seen these kind of volatile moves. And that has definitely transferred into the entire Korean market. And that's quite understandable given that the turnover of the entire market, 70% of it is driven by the two chip stocks, Samsung and SK Hynix, and the leverage ETFs that track them.
I don't know. What's next?
Well, what's next would be definitely the leverage ETF space. That's what everybody's talking about. I just talked to a trader who said that all these speculative trades, these products will ultimately end up in tears for these retail investors. We do see a lot of that happening, especially with the sell-offs that's been happening. And we have seen, especially the 16 of these products that was launched in the late May in Korea, following the successful debut of the CSOP ETF in Hong Kong. We have seen a lot of Koreans actually have gain exposure to SK Hynix and Samsung through these leverage ETFs. So yesterday we had the financial regulator who urged the asset manager CEOs to actually look into these ETFs. There were a lot of voices clamoring about even curbing these ETFs, even delisting of some of these levered products.
Sang-mi, thank you. Sang-mi Cha there in Korea for us on, the stock story really of the year so far. Okay, just an update. We are getting further updates here coming out of the U.S. side. The U.S. has completed new strikes on military targets in Iran. Also saying some context, more than 50,000 U.S. service members have deployed across the Middle East. Lots more ahead. This is Bloomberg.
All right, we are looking at U.S. futures here now, starting to feel a little bit of the headline risk that we've been tracking here the last couple of seconds here. And really, the latest has been the U.S. has completed new strikes on Iran military targets. They've struck across Bashir, Chabahar, Jask. And they also are talking about more than 50,000 U.S. service members have been deployed across the Middle East right now. Oil markets are certainly still perking up here this morning. We're talking about Brent back to around $85 there. And certainly that's one thing we're watching very closely. And of course, WTI is also close to that $80 range. Let's bring in our Middle East correspondent, Abir Abu Omar. She joins us now from Dubai with the latest. Abir, we woke up to this new reality of potentially new tolls from the U.S. when it comes to the Strait of Hormuz, more flare-ups there in the region. What's really caught your eye?
Good morning, Yvonne. So, we're seeing again what we've been mentioning yesterday about those tit-for-tat attacks continuing to happen into the early hours of this morning. A little bit more complications occurring on the Strait of Hormuz, with President Trump yesterday saying that that he's reinstating, first of all, the blockade on Iranian ports. And that's what he said would happen by 4 p.m. New York time later today. And then they will continue, that's the U.S., will continue attacking Iran. CENTCOM, as you have just mentioned at the top of this segment, said that they just finalized the last set of attacks on Iran, including on some southern provinces in Bushehr. Now, there's a lot of military assets there that we're keeping an eye on. That is essentially what the U.S. has been saying it has been targeting. And then, aside from the blockade that is instated on Iranian ports, President Trump also said a 20% fee on cargo ships passing through the Strait of Hormuz. That's another thing that we're keeping an eye on. On the Iranian front, Abbas Araghchi, who is the Iranian foreign minister, said that the Iranian side has been more reasonable when it comes to instating those fees. He said that Iran will continue to be the guardian of the Strait of Hormuz, and that will not change forever. Now, this is on an X post that he had posted a little bit after President Trump made his comments. And so we're seeing more complications by the day. You're mentioning Brent crude prices that are at $85 on the barrel. That is the first time we see those levels in a month. Yesterday's gain was the biggest in about 5 years. And so you're seeing the market reaction almost instantly reacting to this news that is happening by the second. Iran also retaliating on countries in the region, namely Kuwait, Oman as well, Qatar over the weekend. Qatar was mediating up until a week ago between Iran and the United States. So we're not seeing anyone that is protected from this wrath of both sides of the table at this point, really.
Abir, thank you so much. Abir Abu Omar there are in the Middle East in Dubai for us, our Middle East correspondent. Their show is going to be very, very busy today. Stay tuned, of course, for Horizons Middle East in about an hour and a half from now. Okay, just to juggle a lot of news coming through as well. The ongoing briefing in Beijing, it's the Customs Bureau trade numbers for June. Finally out, we had the trade surplus number. for the month, coming in at just under 860 billion. That's renminbi. In dollar terms, that's also out, the trade surplus number, clear of about 5 billion from estimates. 126 billion US dollars was the Chinese trade surplus for the month of June.
Yeah, so pretty strong numbers still when it comes to what we saw in June. So certainly it looks like this is a third straight month of really export growth when it comes to that side of things. What has been fueling that story really has been AI hardware, right? And really what we've been seeing here that has really flattered a lot of these numbers, and certainly a lot of questions on just how sustainable this export sort of engine can be for China at a time when consumption still seems to be struggling quite a bit. So let's get more on the outlook when it comes to markets. Joining us from the Bank of Singapore Summit in Hong Kong, we want to bring in Fabiana Fedeli, M&G Investments CIO for Equities, Multi-Asset and Sustainability. M&G manages about $444 billion in assets, to be exact. Fabiana, it's great to have you back in the region. It's been a long time. You know, we start off with some of the headline risk, really, when it comes to Iran. It seems like geopolitics and this sort of war premium is coming back in a big way across these markets. You know, how seriously are you looking at the situation in the Middle East here right now, and how does it really dictate how you look at, you know, asset classes overall?
Yvonne, it's great to be with you and David. The situation is serious because the longer the conflict lasts, the more volatility there's going to be on energy prices. The higher they're going to be, the worse the impact is going to be, not only on inflation, but longer term also on demand. And hence we are concerned. And by the way, the longer the conflict lasts, also the bigger the damage is going to be on infrastructure on the energy side. So that remains one of the big points of focus that we have when we look at the macro and geopolitical arena.
Fabiana, David here, also very, very nice to see you. Very short-term question for you. Do you get a sense that it's probably wise to take some risk off your portfolios over the next few weeks?
Look, what is happening in markets right now is really interesting. The leadership of equity markets in particular is very concentrated. And I am concerned about the impact on some of the indices out there because there's a very high concentration from a risk perspective. I mean, we know there are really 3 companies that are preponderant in Asia indices. We know that half of the S&P 500 is really made out of 24 companies. So I am very concerned from that point of view. But there are still exceptional companies out there. There's still companies where valuations actually have been left to languish because of that concentration on very few leaders at the moment. And I still believe there is a lot of value in markets.
Yeah, can you talk a bit more about that, Fabia? Because it seems like the market is really just trading on very narrow themes, as you mentioned. I mean, AI, industrial policy, reshoring. Well, the gaps that we're seeing when it comes to valuation are getting wider, it seems. Where are sort of the best kind of opportunities for you when you look at the rest of the year now?
So if you look at what is happening right now, if you want short cycle demand, companies have been at the forefront of investors' interests. But there are other opportunities that actually are also related to AI. Think about longer cycle demand players, such as opportunities in electrification, in power infrastructure, in the enablement of industrial technologies. And the other part of the equation is all those companies that are implementing AI and they're actually starting to see a benefit from AI on their operations. And these are companies that are not necessarily in technology. They can be in healthcare, they can be in industrials or in finance. So the opportunity is broad. You really have to know the companies you invest in at this point in time.
Okay, well, Fabiana, that's a good starting point in terms of the concentration issue, which we keep going back to. What's the framework that you and your team use to determine whether you want to be embracing that concentration or doing the opposite?
Look, what one of the things that we've learned over a long time in markets that you never want to be all in or all out. And there is a real peril to make any big grandstanding moves on markets. So while we still like some of those AI enabling technologies, we still like some of those companies, we have started slowly to rotate into other opportunities. And I think this kind of more balanced view will probably prepare the portfolio for the winners of tomorrow. One thing that we know is that leadership is never always the same. The leaders of today will be different from the leaders of tomorrow. And so you need to start to prepare those portfolios.
Is diversification still something then that we hear a lot from guests and a lot of your peers? But when everything is so crowded and concentrated, I'm just wondering what is sort of the value in diversification now?
Yvonne, we actually just published our outlook yesterday, and we talked exactly about that. In a market where you have so much concentration, does diversification still stand as one of the pillars of your portfolio construction? And the answer is unequivocally yes. It does, because as we said earlier, the leaders of today are not going to be the leaders of tomorrow. And so getting ready, prepared for that change in portfolio leadership is absolutely important. And also diversification still helps you to diminish the downdraft on some of the portfolios, because we're seeing some extreme views in stocks. And don't forget that the best way to make money is not to lose money.
Yeah, okay, well, easier said than done. What's the other side? So if, obviously portfolio construction, we talked about equities. What are the other asset classes that should go into a balanced longer-term approach then, currently?
So we really like government bonds within fixed income because we have seen actually yields at high levels. But we have to think about them in a different way, not anymore as a part of strategic asset allocation, but more as a tool of tactical asset allocation. Trading around some of the yield movements, particularly in developed market bonds, has actually been a very profitable investment tool. And then, of course, EM market bonds. I mean, we've seen local currency, actually. We see a lot of stability there, high returns. And, for the longer term, we would still hold them in our portfolios.
Fabiana, talk a little bit more about that. That's a very unique take on fixed income, government bonds specifically, as a tactical opportunity in DMs. Wondering if you could be more specific, what are the best tactical opportunities right now in DM rates?
So you've seen, for example, UK gilts respond not only to the expectation of higher rates, but also to the concerns of policy errors, particularly when it comes to potential subsidies for energy cost. And you've seen literally the yields fluctuating. And sometimes there is such an extreme reaction to news flow that trading around that extreme reactions, we call them episodes. Actually, it is a very profitable investment process tool. And on the emerging market side, we still see, if you want, high real yields and an opportunity for the longer term. Emerging markets, central banks have been extremely orthodox in their behavior. Their debt exposure is actually, in many cases, lower than developed markets. And also their growth expectations are higher. And there we really see, if you want, a longer term investment.
Yeah, it's interesting. You mentioned some of the traditional safe havens are no longer behaving the way they used to, right? I mean, bonds certainly is one thing. You can add gold into that too, even the yen. Fabiana, so do you think the playbook is? I mean, what is the playbook now, and how should I look at these kind of traditional safe haven assets?
You're right. I mean, some of those kind of rules of thumb that we were taught many years ago when we started in the investment world have completely changed. And perhaps we don't have a rule book anymore. But this is also the reason why some of the largest investors and asset owners out there are turning from the traditional structural asset allocation to what we call total portfolio allocation, a much more dynamic way to look at different asset classes, to actually distribute investments across asset classes, depending on their relative risk-reward profiles, rather than a set, if you want, percentage of your portfolio that doesn't change over the longer time.
Fabiana, thank you so much for the time. It was very nice to see you. Nice chatting again after some time. Fabiana Fedeli there, CIO for Equities, Multi-Asset and Sustainability at M&G Investments. I think we just touched on Korea there. So they're just out with some changes to their economic projections. They're raising their growth forecast, to 3%. The previous forecast was for 2%. And on inflation specifically, it's going to be interesting because I think we have a BOK decision coming up too, 2.6% for 2026.
Yeah, and largely expected to hike at this meeting from the BOK is certainly one thing to watch. You're also hearing here from the finance ministry talking about won volatility. So they're going to strengthen the 24-hour response system when it comes to the currency. And they're going to ease the FX rules on capital transactions significantly here. So maybe some measures to tame some of the volatility that we've been seeing across FX markets there. There is some strength in the won here today that we're tracking here as well. On the flip side, we're tracking what's going on with the June trade data coming out of China as well, which look to be pretty strong numbers across the board when we look at exports and imports, both beating the median estimates here as well. Oil imports is quite interesting. Yeah. So they broke down some of these numbers for us for June. 29 point, I'm going to round it out, 3 million tons. That is down 41.3% year on year. So you still continue to see that the soft, I mean the slowing in terms of these oil imports here, which has in some ways really helped oil markets and really the balance, really the supply and demand dynamics there up until recently, right? But we'll see if that continues, right? There have been some signs of refiners and the like looking to replenish their stockpiles in the last couple. After the last couple of months. Yep. But you got to wonder.
Massive drawdown there.
$80, though. Would they be willing to buy at that price?
That was the question that Nicholas Lua was posing earlier for us. I'm staring at this massive Excel file of the commodity imports from China. We will dig into these numbers and we will bring them to you in terms of any key takeaways from this. Lots of data coming through as well. Lots more ahead, suffice to say. This is the China Show.
Just recapping some of the data that we got here when it comes to China trade. I think we've got the whole set here right now when it comes to dollar and renminbi terms, but all looked pretty good when you take a look at the month of June. So we're talking about 27% growth in exports year on year. Imports were also up some 36%. So that is certainly leading to a pretty good trade balance and surplus there as well, and really beating expectations here this morning. We talked about the oil import side of things. A lot of the questions and really what has been helping these numbers certainly has been the AI hardware space, but also when it comes to EVs as well, Dave.
Yeah, so I'm actually looking at, and I'm glad you brought it up, I'm looking at the biggest export markets for June. So let's set Hong Kong aside because that's obviously a pass-through there. So Japan is up, South Korea is up to your point on AI. 31% exports to China is up 31% to South Korea. To Taiwan is up 10%. India is up 15-16%. ASEAN, which is, of course, a very big export market and as far as EVs are concerned, get this. The number is up 23% year to date. So that's January to June, just to underscore that point in terms of AI and EV. Exports are concerned. And yes, we are getting some price upgrades to coming out of Goldman. I think raised to buy NEO, $55 is our price target there coming out of Goldman Sachs.
Yeah, you're starting to see the likes of NEO up some close to 6% here. It's interesting. You got to wonder what's been going on with Iran. Does this kind of revive the whole EV trade in China once again, given the fact that oil prices are coming back up here, and maybe that's why the sector is doing quite well in the face of that. Also, there was news of Dongfeng. This is, of course, the other Chinese car maker is preparing to sell EVs into China as well.
Canada.
Sorry,
yes.
Canada.
Yeah.
Can't read today.
Let's continue that. So China's EV sector
We're confusing ourselves.
is now plagued by overcompetition. We know that's been a feature of the industry in recent years. You have a lot of players producing too many cars, and Beijing's efforts to offset a sluggish domestic market, to our point earlier on, with overseas growth, has become a major source of tension with trading partners.
Yeah, especially with Europe, right? We certainly have seen those tensions flare up. Let's bring in Juliana Liu, our Bloomberg opinion columnist. She says the surge of China's EV sales in Europe is an example of that problem that will be difficult to solve. Juliana joins us now. Why do you think it's so tough for the sector to consolidate?
So we know that there's overcapacity. It's something to the tune of 50%, which is unsustainable in other countries, but China is able to do it because it's got that scale. So what I'm arguing is that it's extremely difficult to consolidate, and that's in part because of how the industry developed. Those pressures actually have never gone away. So if we kind of look back in time, in the 1980s, China actually didn't mean to incubate 100 plus EV makers. Their intention was to incubate less than 10. There were 9, 6, and then 2 plus 1, 9 kind of state-owned companies that they wanted to give all their effort to. So these are the players that got the extra kind of state credit, subsidies. They're picked joint venture partners when all the Western car makers came to China. So those companies got all the incentives. But what happened is that around the periphery, regional and local governments said, well, we want these jobs too. We want jobs, we want taxes, we want promotions, and we want bragging rights. I think that's something that is not recognized so much. They wanted to be able to have these kinds of players too. So what they did was they used the resources that they had. They begged, borrowed, however it went, and they hooked up with private companies, private car makers that also wanted to develop their own products. A lot of times these were, car parts makers or other kind of entities. And now what we've seen is because they're scrappier and they wanted it more than the state-owned enterprises, these are the companies that we're seeing here getting the upgrades. These are the ones that are now dominating the charts in terms of sales. And because there was a divide between kind of what Beijing had intended and what actually happened, there's still a lot of pressure for local governments to be creating jobs. And they still want to create, more EV companies or other kinds of companies. That's why you're not seeing the consolidation. In fact, last year, according to AlixPartners, there were more than 20 new entries, brands that hadn't made EVs before that made at least one. And there were, only, I think, 9. I mean, I've got the chart somewhere. Yeah. There were only a few exits at a time when margins are really, really thin. And there's incredible competition and so much involution. So I think the whole consolidation process is going to take forever, right, because there's so much incentives for local governments to continue to prop up, in some cases, loss-making car makers.
Right. Well, so in the meantime, though, should we expect exports to continue to remain sort of that valve that addresses some of the sort of underlying economics? And will this continue to cause some worries around trading partners, for example, too?
Yeah, I think it will, because if you look at the domestic market, it's shrinking. So I think we're expecting the domestic market to be 10% smaller this year than it was last year. As we know, the domestic economy in China is really struggling. And so how BYD and others are able to boost their numbers is by exporting like crazy. And that's what we've seen, right? Export numbers up 65% in the first 6 months of the year. The Iran war is giving a real boost to that. Southeast Asia, some of the biggest buyers of Chinese EVs, a lot of countries are doing that pretty much, with the exception of maybe the U.S. Yeah. Everyone is kind of buying these cars. I think it's going to be very difficult for the industry to shrink.
Okay, you can check out Juliana's column on the Bloomberg terminal for our clients as well, and also going to be on the website. Juliana Liu there, our Bloomberg opinion columnist. Lots more ahead. Right. Quick glance at equity markets before we wrap things up. And of course, the pain point is really on the right side of your screens with energy prices again back to the mid-80s. And as far as Brent is concerned, yep, the Middle East story continues to give. SK Hynix is, of course, the other feature to the market story of late. That's it from us here on the China Show. Insights with Haslinda Amin, or with Heidi. That's actually coming up next. This is Bloomberg.